been almost a year since you suffered a pretty major health scare. So I just want to begin by asking, how are you?
Yeah, I'm doing great, actually. I'm exercising again. I've got most of my health back and been coming to the office since June, pretty much. So happy to be back at work.
Let's talk about competition. You recently told your bankers they should be scared, expletive, about the threat posed by financial technology companies and others coming into the industry. Isn't that a bit defeatist?
A little bit, but I didn't mean it quite that way. So many years ago, we sent an airplane full of people to China to go all the competition. So JPMorgan itself is doing great. So all of our people, look at it, we're doing quite fine. But you have fintech, big tech. You saw Walmart recently. So we just have to be prepared for intensified competition. We're ready for it. We're very competitive, and we expect to win.
But prepared how? What does that mean? Do you have to go out and buy something? Can you build it organically? Do you invert the Walmart model and just start opening delicatessens to compete toe-to-toe?
No, so we already have 5,000 branches. We're going to open another 400 in the next couple of years. We'll be in all 48 states. And of course, those branches do a lot. They take deposits, they do wealth management, they do small business lending. They are really important to private banks, commercial banking clients, et cetera. So no, we've got the people, the capability. We can do 100% organic. However, we're open-minded. If people have ideas for us about acquisitions or partnership, we're completely open to have those conversations too.
But the growth of some of these fintech companies, if I look at Adyen or Stripe, for example, it's been so exponential. And then I look at what some of your competitors have done, Morgan Stanley notably with the E-Trade deal. Do you not think there would be a case to be made that JPMorgan should go out and just buy one of these giant fintech companies, plug it in, and then you're good to go?
Yeah. So you should assume we look at everything. And like I said, some of the things we do ourselves, we've done quite well in these areas too. But you're absolutely correct. Some of these people have done a great job. And sometimes it's not cheaper. It's not even better. It's usually just ease of use or something like that. But I assume they're coming. I've dealt with competition my whole life. And we're open-minded to acquisitions. We're open-minded to building ourselves. But what we tell the people here in this very room, in fact, is we should do what we need to do to win in technology, people, systems, marketing, analytics, AI. And obviously, we're doing an awful lot of AI and cloud work and things like that.
Another thing fintech has done, or at least is partly responsible for, is this sort of democratization of investing. Obviously, the rise of the retail trader, the Reddit crowd, Roaring Kitty, whatever you want to call it, is creating this narrative at the moment of David v. Goliath. Now, as a very prominent Goliath, do the Davids have a point? Is the system rigged?
God,
or stacked against them, at least.
In every bull market, this has happened in my life. So this is not a new phenomenon. And I do believe that people should learn how to invest their money, but they should do the homework. I mean, thinking you go on and just gamble and play, that doesn't have a long-term success record. And so, but to the extent that people are learning and they're getting involved, so that's a good thing. So for some, it's going to end badly, and for some, it'll probably end up well. But the best investors learn over a long period of time how to be a good investor. Just like the best tennis players, the best boxers, the best media folks, the notion that you can be great at it because I remember my daughter made her first investment and it went up, and I was thinking to myself, oh God, it would have been far better had it gone down. You learn a little bit more that way sometimes.
Well, one bit of the industry that obviously has been savaged to some extent recently is the short-selling hedge funds. Do you think that industry is in crisis because of this effect we're seeing, or this phenomena of the retail trader?
Absolutely not. The retail trade in dollars is a teeny, what you're talking about is a teeny weeny little bit of the market. The market is global. I mean, something like $10 trillion is bought and sold every single day. And when we say investors, you're talking about retail investors, pension plans, hedge funds, money managers, individuals. I've been buying and selling stocks since I've been 12 or 13. So I believe in that. But my dad taught me how to read a balance sheet when I was 13. It wasn't just, maybe I was guessing a little bit, but look, it opens it up. But no, there are legitimate complaints about short selling, more around transparency and the duplication of the ability to short sell the stock. There are legitimate issues around all these things. If the regulator is going to be looking at payment for order flow, high frequency trading, disclosure about ownership, voting, short selling, those are good things. And to me,
should people be able to pay for order flow?
I think payment for order flow is a very complex subject. I think there should be but there should be much stricter rules about what you mean by that. It's not clear to me that everyone does the same payment for order flow. So if I'm paying a lot more to someone else or keeping a lot more for myself, you probably have the right to know. And there are certain disclosures that are not very good.
Moving on to the biggest question in finance right now, which is the stimulus enough? Is it too much? even the interventionists can't seem to agree on this point. You have Larry Summers on the one side saying enough already. You have Janet Yellen, Jay Powell, and others on the other saying more is needed. What do you think?
So getting through COVID is absolutely critical, and we're still in it, though God knows it looks like there's light at the end of the tunnel, by the beginning of the summer or something like that. And it's not a binary subject. I think, Democrats and Republicans are like ships passing the night. There are legitimate complaints about stuff in this bill that has nothing to do with COVID. There are a lot of people suffering who need help. Both are true. So if you want to go through, you go through all the detail. Unemployed, they definitely need help. Small businesses, they definitely need help. People at the lower end, they definitely need help. Women who had to go home, who basically stopped working because they had to go take care of something like that, they definitely need help. I don't know if you know this, but like half the states, revenues went up. They didn't go down. Do they need help? And we just throwing money at people at one point. So, and there will be another side to that mountain. So they should be cautious about overdoing it. Get us through the problem, get the country growing, but don't try not to overdo it too much.
But isn't the risk exactly that if you have places and states, people that don't need help and getting the help, you overflood the system. Yeah. You do create this huge risk of inflation.
Yeah, and the system already has a little bit of that. So if you look at what's in the system, it looks to us like there's $1 trillion, $1.5 trillion that's unspent. That's before this $1.9 trillion. So there will be money. There's a very good chance you're going to have a gangbuster economy for the rest of this year and easily into 2022. And the question is, does that overheat everything? And we just don't know yet. But I would put that on the things to worry about. I wouldn't worry too much about it. I would worry more about COVID and nuclear war than I'd worry about that. But I would suspect there's a pretty good chance you're going to see rates going up and people starting to worry about that at one point.
Let's talk about COVID for a second.
I've been very clear. I would not buy 10-year treasuries, just so you know. Right.
On COVID, we are obviously doing this interview in person, which is fantastic. We're doing it in your offices here in New York, but still largely empty, as are my offices, as probably are a lot of people's offices. How important is it to a business like JPMorgan to actually have people physically coming back to work?
It's very important. I do think there'll be part of the world where a certain amount of people work from home permanently, certain sales, certain ops, so you can track the productivity, et cetera. I think there'll be a large portion who permanently work in the office. Think of our branches, cash management, probably most of the trading floors, et cetera. And there'll be some hybrids where you spend 2 weeks at home and 2 weeks in the office, or 3 weeks at home, a week in the office, or 3 days and 2 days and 2 days, 3 days. So I think it will reduce the need for commercial real estate, but there are huge weaknesses to the Zoom world. Most of us learned by an apprenticeship system, by seeing mistakes, going to trips, how do you handle a client, how do you handle a problem. So it's hard to inculcate culture and character and all those things when you have the Zoom world. Spontaneous combustion, it goes away. Hard to manage. It's hard to be very critical. You got 15 people on the screen. So what before was like a deep dive question, now it looks a little bit rude. And I took a trip to California and met 100 people all outside, all wonderful, breakfast, lunch, and dinner. It's amazing how much you learn about your own business, your own bankers, your own clients, your own products. And I met with Snowflake and Marqeta. What you learn about technology and systems, you're not going to do that in the Zoom world. And so bankers, relationships. I think it's very hard to build and develop and deepen a relationship on the Zoom world. So you still, there'll be more Zooming. People like me will travel just as much as I did in the past.
As and when the vaccine does become available for your workforce, will you make it mandatory for people to take it if they do want to return?
It's hard to make it mandatory. And there are laws about that. But I think what we'd like to do is kind of have carrots and sticks. We want people to take it. I think it's a far better thing. You certainly can't make it mandatory before it's fully accessible. So that question can't even be answered until June. But I do think you may see some companies do it. I can see an airline doing it or a hotel company doing it. I can see some people saying if the folks in our branches aren't vaccinated, they're not going in. So there will be pressure. And I would say carrots and sticks, not mandatory.
Another topic very of the now is SPACs. I'm interested why, when I look at the league table, does JPMorgan not seem to be doing especially well in the SPAC game?
Yeah, we were a day late and a dollar short. Probably a little skeptical going in.
Are you still skeptical?
I think you have to be cautious, okay? So I think if it's a good sponsor, if it's a fair sponsor deal, if it's got good pipe investors, if you really do due diligence in the acquisition, these things can make sense. But clearly there's a lot of hype. There are a lot of sponsors that you shouldn't be doing business with, and so some of them will not end well. It doesn't mean you shouldn't do them, and it doesn't mean there aren't some good ones. But to us, we want to hold to JPMorgan standards the people we actually do business with.
Just turning to my home country for a moment. Look, I know you've been hesitant in the past to opine on UK sovereign issues, but as a Brit, I can tell you there are scores of us, thousands of us, who would love to hear your opinion on London, particularly. What is the future for London as a financial centre now that we have gone through Brexit and this sort of much harder version of Brexit than many people expected?
On Brexit, and I always got notes from Brits saying, "Go home, Yankee. keep your opinions to yourself." Look, I was not in favor of hard Brexit. We had a hard Brexit. It's going to cause difficulties. You've seen them. It's going to reduce their GDP, all things being equal. Look, I've always understood why you want to free yourself from what people considered a sclerotic Europe. But it may not play out that way. So if I was a Brit, I'd be really careful about how you're going to compete in the new world. You have to deal with Europe. You're going to have to deal with all these other trading partners, et cetera. In terms of financial services, there was no deal done. So you really don't know. And now we're arguing equivalency or not. I think my view is what you're going to see is over time, parts that were done in London will be done elsewhere. So London will always be a financial center. It won't be the financial center of Europe. You're going to get other financial centers like Paris and Frankfurt, Dublin, maybe Amsterdam. And you've seen it already in certain products. That doesn't mean it won't extend to other products. Like, if equity trading, why not FX trading? Why not bond trading? Why not? And I do think there'll be political and regulatory pressure over the next 10 years to move some of those things. So, and we want to leave it just the way it is. We love London. We love Britain. It's very efficient for us. And it's very efficient for our clients. It's much cheaper, et cetera, to leave it the way it is. But that's got to be settled between Europe and Britain. And so far, it doesn't look particularly good.
Much easier question for you. We're obviously sat here in New York, your home city. There's a lot going on in New York right now. There has been an exodus in the financial services industry, a lot of very smart people, big companies moving elsewhere. What keeps a business like JPMorgan in New York?
Yeah. So again, I think New York could have a little bit of a difficult time too, because already real estate needs will come down. Most of us are going to go to more open seating because you don't need 100 seats for 100 employees. You're going to need like 60. And then, of course, if you have higher individual taxes and higher corporate taxes, that does a pretty good job driving people out, as does crime, an inhospitable business environment. So, what the city needs to do is make itself what it has been for, just like London, a wonderful, absolute place to work and or visit. So that's the arts, it's the sciences, it's the parks, it's the safety, it's the soundness, it's the tax system, and for London, it's the rule of law, it's all the things that surround the financial system there. It's the lawyers and the accountants and the tech people, and they're all kind of important. So we need to do that here. You're going to have some exodus anyway, because some of the bad stuff has been happening too much, and you've seen a bunch of people already kind of vote with their feet and leave the city. So, but New York can fight back. It's just got to have a real strategy.
Before we go, just a quick Jamie Dimon question. You're going to be 65, I think, next week. Yeah. You've been in the job since 2005. Obviously, I think the only bank CEO of a major bank to have gone through the 2008 crisis, still be navigating through the COVID crisis. It's not up to you, obviously. You have a board and shareholders. But if it were, how much longer would you want to do this job for?
5 years.
That's the only answer. I know that was going to be the answer.
It's the only answer I've ever given. So, but it will be up to the board. We've got great people here. They did a great job running this company when I was unable to. So, which I think proves that we got people in place who can do these things. And so,
how many people of your direct report group could actually step up and do the CEO job?
I think the ones I'm going to mention are Gordon Smith and Daniel Pinto. There are others, but those two co-presidents, co-chief operating officers, they did it when I wasn't here. They've done an outstanding job, and obviously we have tons of exceptional people.